All right, let's get right into it. If you're prepping for the CPA exam, you already know that governmental accounting isn't really about crazy calculations, it's all about placement. And today we are tackling two of the biggest placement topics out there: capital assets and long-term liabilities.
Now, there's a reason we're smashing these two topics together. It's because the exam tests them together. They both revolve around the exact same core concept. The reporting looks totally different depending on which financial statement you're in. And a quick heads up, this explainer builds directly on our last session covering government-wide versus governmental fund statements. We're not going to re-explain measurement focus or basis of accounting here, so if you're a little fuzzy on that, you might want to check that one out first. Okay, here's our game plan. We're going to start with the one single rule that drives everything. Then we'll see how it works with capital assets and then with long-term liabilities. We'll do a quick check-in on proprietary funds and then wrap up with the most common exam traps you need to dodge. Let's dive in.
Seriously, this next slide is the whole foundation. If you can get this one single rule locked in, you are 90% of the way home. Every single thing we talk about today comes right back to this idea.
Here it is. This is the whole enchilada. Governmental funds are all about the short term. They only care about current, spendable resources. So, by their very definition, they have to exclude long-term things like buildings and bonds. On the other hand, the government-wide statements, they're showing the big, long-term economic picture, so they must include them. This isn't just some random rule to memorize, it's the entire logic of how governmental accounting works.
And this table right here really shows you the why behind the rule. You see, since governmental funds use that modified accrual basis and focus only on current financial resources, well, of course they can't report long-term assets and liabilities. It just doesn't fit. But flip that coin. The government-wide statements use full accrual and an economic resources focus, so of course they have to report them. The focus dictates the treatment. It's that direct.
So for any exam question that touches this stuff, I want you to use this 4-step mental checklist. First, what statement am I in? Is it a fund statement or government-wide? Second, does this long-term item even belong here? Third, okay, if it does, what is it? Is it an asset, an expenditure, something else? And then, only at the very end do you think about the journal entry or the accounting treatment. Always, always, always remember placement before mechanics.
Okay, let's put that framework to work. We'll start with capital assets. We're going to follow a single transaction and see how it gets reported in two totally different universes, all depending on which statement we're looking at.
First, let's make sure we're on the same page. When we say capital assets, we're talking about the long-term physical stuff a government uses to operate. You know, buildings, fire trucks, and big infrastructure like roads and bridges. And to keep things objective, they're always put on the books at their original historical cost.
So, let's walk through a classic exam-style problem. The city of Ridgeway spends $1 million to build a brand new road. How is this single event going to show up in the financial statements?
And boom, here's our core rule in action. From the perspective of the governmental fund, which is just tracking where the cash went, spending $1 million is a capital outlay expenditure, period. The money's gone, it's been used. But look at the government-wide statement. From its long-term perspective, that same $1 million created a long-term infrastructure asset that will be depreciated over its useful life. Same transaction, two completely different stories.
Now, just when you think you've got it down, there's a big exception. And trust me, the exam loves this one. We just said infrastructure gets depreciated at the government-wide level. Well, not always.
This is called the modified approach. A government can actually choose not to depreciate some of its infrastructure, but only if it meets two really strict conditions. One, it has to have a sophisticated system to track and manage these assets. And two, it has to be able to prove, with documentation, that it's spending the money to keep those assets in good shape, at or above a certain condition level. The logic is pretty simple. If you can prove you're preserving the asset's service capacity through maintenance, GASP says that maintenance expense can take the place of depreciation expense.
Okay, let's switch gears. We're going to apply that exact same core rule, but now we're going to look at the other side of the balance sheet, long-term liabilities. And you're going to see the logic is identical. It all comes down to that short-term fund view versus the long-term government-wide view.
So we're talking about things like general obligation bonds, debt that's not due for more than a year. This is how governments pay for those huge projects, like the schools, libraries, and that new road we just talked about. All right, let's run another transaction through our two lenses. This time, the city of Ridgeway issues $500,000 in bonds to build a library. The cash hits the bank account. So, where do we report it?
The difference here is night and day. In the governmental fund, which completely ignores the long-term debt itself, that $500,000 in cash is recorded as an other financing source, and it is absolutely critical you see that this is not revenue. Meanwhile, the government-wide statement tells the full story. It shows the economic reality by recording a $500,000 long-term liability for bonds payable.
You have got to burn this term into your brain. Other financing source, or OFS. One of the most common exam traps is confusing bond proceeds with revenue, or trying to stick a long-term liability on a governmental fund's balance sheet. You can't. In the fund statements, cash from issuing debt is an OFS.
And this short-term thinking continues when it's time to pay the debt back. The debt service fund doesn't sit there accruing interest expense day by day. Nope. It only recognizes an expenditure for principal and interest when the payment is actually legally due. It's a when-due system, not an as-incurred system.
Okay, let's do a quick sidebar on proprietary funds. They actually provide a really great contrast that helps lock in this entire concept.
Think about a city's water utility. That's an enterprise fund, which is a type of proprietary fund. It operates just like a regular business. So they use the exact same long-term full accrual logic as the government-wide statements. If that water utility buys $200,000 worth of equipment, it records it as a capital asset on its own statements and starts depreciating it. They handle their own long-term stuff directly.
All right, let's bring it all home. We're going to finish by reviewing the absolute most common points of confusion. These are the traps the exam writers just love to set for you. Let's do a final rapid-fire review. Remember, in a governmental fund, buying a capital asset is a capital outlay expenditure, not an asset. Bond proceeds are an other financing source, not revenue or a liability. Debt service payments are expenditures when they are due and payable. The modified approach is the one big exception to depreciation for infrastructure. And finally, proprietary funds act like businesses. They use long-term accounting. If you can master these 5 distinctions, you are in fantastic shape.
And it all comes back to our framework, placement before mechanics. So the very first question you have to ask yourself on test day is, which financial statement am I in? Is it a governmental fund, government-wide, or proprietary? Answering that one question right is the single most important step to getting the whole problem right.